Welcome to EQUIS Institute. Today we are going to talk about the passive versus active debate. By active versus passive, we're talking about active money management and passive money management. One way to think about this debate is to think in terms of alpha and beta, which is the way investment managers frame the problem. So what is alpha and what is beta? Well, the definition for alpha is fairly straightforward. Alpha is the abnormal performance that any active manager can generate above and beyond the fair reward for the risks taken. In this context, by contrast, beta measure the portfolio exposure with respect to underlying rewarded risk factors. In other words, everything that is not explained by factor exposure or beta can be regarded as alpha or abnormal performance. Alpha has become the word that we use for measuring manager skill precisely because it is related to this abnormal performance that the manager can generate above and beyond the risks taken within the portfolio. More often than not, this abnormal performance is generated on the basis of security selection decisions. Let's call that stock picking when we are in the equity universe. So a manager will start selecting undervalued stocks, and the idea would be to try and form a portfolio that will outperform the benchmark on a risk-adjusted basis. This is actually the definition of an active manager. A manager is said to be active if the manager tries explicitly to outperform the benchmark. Okay, now here is the problem. Active portfolio management doesn't really work well, as we will see. So we just said that active managers try and outperform the market or the benchmark. Well, the market as measured by some benchmark. So let's take a look at their outperformance or lack thereof to see how successful they tend to be in the context of this attempt at outperforming the benchmark. Well, the reality check is actually fairly straightforward. Very few managers do outperform the benchmark. And in some cases, outperformance can be extremely severe. So if you look at the graph on the upper left corner, give us a sense of the percentage of the managers that actually did end up underperforming the benchmark. And if we look at a fairly long time period, like 5 years, then the conclusion is, well, there's a vast majority of the managers who end up underperforming. Now, there is worse than this. This graph shows the percentage of managers that actually underperform by a substantial margin, in this case, 200 basis points annual. Conclusion so far, it seems that managers do not succeed on average to outperform the market, and actually very few of them can outperform, and quite a few of them do underperform severely. Now, this is based on somewhat ancient data. So let's take a look at more recent data to check if perhaps alpha, which in this case is actually negative, so these active managers are by and large destroying value. Let's see if we can do better in the short term. Well, the situation is not exactly improving, so now we're looking at the time period, which is 2003-2012, and we're looking at all the large cap US managers trying to outperform the S&P 500 index. And this graph shows the distribution of these manager performance. Now, as we can see, only 18% of them did outperform, 82% underperform, and some of them actually underperform by a lot. We're looking at 4% underperformance annually. That's a huge underperformance. Okay, well, so the conclusion is beating the market must be really hard if so few managers can actually succeed in doing so. Now, let's take a look at the most recent data that we have. By mid-2017, over the last 15 years, 93% of the large cap US managers, 94% of the mid cap managers, and 94% of the small cap managers did underperform. Okay, so they are only over a long period of time, in this case 15 years, there are only just a little more than 5% of them that did succeed in outperforming the market. So the conclusion is, well, beating the market must be really hard. We've got to keep in mind, by the way, that statistical evidence is always tricky. So even when we're looking at someone who did manage to beat the market, and we find a positive alpha over these 15 periods of time, the question is, how statistically significant is this positive alpha? Well, this is a quote from Bob Merton, who's a Nobel Prize winner in economics for his work on option pricing theory. He also did lots of work on portfolio selection, manager selection, and portfolio construction problems, more generally speaking. And here is the question: how long would I have to observe or monitor my portfolio, which is managed by you, an active manager, for me to have statistical evidence before I can determine whether you are a good manager? Well, if you're looking at the T-stat, which is the word that we use in statistics for measuring the statistical significance, well, I would need something like anywhere between 30 and 400 years. So the problem is, even if we can identify positive alpha managers, we don't even know if this alpha is statistically significant. Okay, well, the situation is not very comfortable. So presumably what we should be doing is, if so few managers can outperform the market, and if we don't even have statistical confidence in their ability to outperform, what we should presumably do is focus our investment in the very, very few managers who did show the highest degree of outperformance. Because presumably, these are the ones for which we have the highest confidence, even though it's not full confidence, but at least the highest confidence that they do have skills and they do add value. Now, here is the second piece of bad news. Beating the market is hard. Consistently beating the market is even harder. So we have to keep in mind that if we select managers on the basis of their past performance, what matters is not only whether they have been able to outperform, which is the question about the existence of outperformance, but outperformance has to be persistent. Well, the bad news is outperformance actually does not seem to persist. So in other words, if you sort managers into 4 buckets, the top 25%, the bottom 25%, and the 25% in between the top and the bottom. And if you're looking at the ability for some active manager who has been on the top 25% over the first period of time, in this case 3 years between 2006 and 2009, only 10% of these 25% were again in the top quartile in the next 3-year period from 2009 to 2012. So the conclusion is, even if you look like a good manager yesterday, there's very little hope that you will end up staying a good manager tomorrow. Okay, so what do we do next? I mean, it sounds like, selecting active managers is almost out of the question. We can never trust how good they are. And even for someone who looks like they are good in the past, they may not remain good looking forward. So the alternative then is to go passive. And passive is all about not trying to be smart and beating the market, but just trying to harvest risk premia, harvest the beta exposure, benefit from this beta exposure, and earn the premium that you deserve in exchange for the risk taken. Passive money management is not a new concept. The first passive fund was launched by John Bogle, who's the founder of Vanguard, who's by now one of the 2 or 3 largest asset managers in the world. And Vanguard launched John Bogle, and Vanguard, they launched the 500 index fund in 1975. So that was the first passive fund trying to replicate, as opposed to outperformance, the performance of the S&P 500 index. So the question is, well, passive money management is clearly on the rise, and there's an increasing number of sophisticated institutional investors that are giving up on any hope for active money management on the basis of the evidence that we just talked about, and they are increasingly turning to passive. So the next question is, well, are passive funds the right approach for investing wealth? Well, unfortunately, it turns out that there's also something wrong with passive money management. So there's something wrong with active money management, which is just very hard to make it work for you. Passive management also has its own shortcomings. So let's take a look. What we're looking at here is the S&P 500 index in the risk-return space. So in other words, we are looking at what's the average return and what's the volatility for holding the S&P 500 index. And then what we do is, on the basis of the 500 stocks in the S&P 500 index, we form the efficient frontier. In other words, we form the set of portfolios that has the highest return for a given level of risk. And here is the conclusion. The conclusion is actually striking. The conclusion is the S&P 500 index is nowhere near the efficient frontier. It's actually very far from being an efficient portfolio. So what we're saying here is, with the passive approach, if you invest in an index fund that delivers the performance of the S&P 500 index, you're not actually receiving the fair reward that you deserve for the risk taken. You're probably receiving half of that reward. You're leaving unrewarded. You're leaving rewarded performance on the table. You only get half of what you deserve. Now, looking at this efficient frontier analysis is a little bit like an unfair competition, because those portfolios are too good to be true. Those portfolios suffer from what we call a look-ahead bias. To form them, you have to know the entire sample information to estimate in sample the expected return vector and the covariance matrix which are needed to compute the efficient frontier. So that's unfair competition. There's a big look-ahead bias. So now we are turning to an alternative to a cap-weighted index, which is an equally weighted portfolio. These equally weighted portfolios do not suffer from a look-ahead bias. To form the portfolio, you don't need any information that is going to be received posterior to the formation date. It's very easy today to form an equally weighted portfolio, right? Anyone can do that. So the equally weighted portfolios are actually fair benchmark for the cap-weighted portfolios. Now, this graph shows an empirical result which is extremely striking. It is one of the most interesting and intriguing empirical results, and more robust empirical results that you ever get in finance. We are looking at 53 countries in the MSCI database, and that's extracted from a paper from a couple of colleagues from ours, from Australia, Platten and Renduk. So what they do is they look at 53 countries in the MSCI database, and for each cap-weighted index for each country, they build an equally weighted portfolio, which is the exact counterpart. By exact counterpart, what I mean is they're using the exact same stocks. So the only difference between the cap-weighted portfolio and the equally weighted portfolio is not security selection. There's no security selection decision, no stock picking, the same stocks. We're just weighting them differently. Cap-weighted tends to be more concentrated. Equally weighted is just more even distribution of wealth across stocks. And then we are looking at the difference in Sharpe ratio, which is a meaningful measure of risk-adjusted performance, the difference in Sharpe ratio between equally weighted and cap-weighted. And guess what? All of those numbers turn out to be positive. Out of 53 countries, there's no exception to the rule that says an equally weighted portfolio has a better risk-adjusted performance compared to a cap-weighted portfolio. Well, so this is an important finding which suggests that going passive and passively replicating the S&P 500 index or any other cap-weighted benchmark may not be the smartest or the best way to go for investing wealth. There's another experiment that has been run by other colleagues of ours, which is actually even more scary. What they've done is they've looked at 1,000 monkeys. Well, we're not talking about real monkeys. We're talking about computer-generated monkeys, which are randomly selecting weighting schemes. And then we are looking at the distribution of the Sharpe ratio, which is, again, this measure of risk-adjusted performance of these 1,000 monkeys. And this bell-shaped distribution, like normal Gaussian distribution that you see here, is the distribution of all the monkeys. Now, this is the Sharpe ratio of these 1,000 monkeys. Now, that is the Sharpe ratio of the cap-weighted index. So the scary finding here is that not only equally weighted beats the benchmark cap-weighted, but even the dumbest of all of these monkeys beat the cap-weighted index. So this seems to suggest that cap-weighted is not a very smart starting point if as a benchmark for active managers or passive managers, if you can outperform that benchmark by using a simple weighting scheme, just like equally weighting or even randomly weighting those stocks.